portion of their safe money. And so that's really the breakout of our clients.
And when you do you take do you look into their whole situation?
We do. We do. In many cases,
mm-hmm.
Tim, it depends on what the client wants, needs, and needs. But in many cases, we get personal financial statements from our clients. So we know the real estate they own. We have a full picture of what they own and have. And we always just recommend what we think is best for them. And then we create a portfolio. It really helps to know their income, to know their other assets. Because if they're getting income from real estate or commercial properties they own or residential rentals that they're renting, it helps us understand what kind of portfolio we should create for them.
So you wouldn't pick a lot of REITs for them or so?
We've never owned a REIT.
Okay. No. Why you don't like them?
No, REITs in general, it takes an enormous amount of work to really understand. They're very different. They're focused in different areas. Some are shopping centers focused, some are commercial focused. They're all different. So you need to really know the management team and trust them. You need to know the geographies in which they're owning the properties, and you need to know the specific niche or segment of real estate that they're in. Because it's very different to own rental properties as opposed to commercial properties, which is very different from industrial real estate or other commercial real estate. So we've never owned that. But one of the things we're doing, Tim, we got very lucky. About several years ago, we found we've never owned a preferred stock. And as I mentioned, many of our clients have balanced accounts. But I was reading the USB annual several years ago, and I saw in their capital structure that they were issuing or had issued preferred stock. So I said, well, this is a great company. I followed it for almost 30 years, 25 years. I'm going to take a look. So I did. They offered a 6.5% coupon, $25 preferred. That was non-cumulative and perpetual, neither of which I like. However, when I read the prospectus a couple times, I noticed that it was a terrific yield, a terrific coupon, and we bought some for our clients, a little above the $25 par. We were getting a 6.5% coupon. It's got interest rate protection. If we hold it, Tim, till January 1st of 2022, and they don't call it, they have to pay us 3-month LIBOR plus 4.5%. So basically, we've locked in a yield that's 400 to 500 basis points above a 10-year Treasury with interest rate protection, and the dividends are qualifying, meaning they're taxed at cap gains rates. So what we've done, Tim, in the last 3 years, we sold all our municipal bonds and we sold all our corporate bonds, and all our fixed income is these types of fixed adjustable preferred stocks. So that's one of the things that we've done.
So when you take over the money from your clients, do you see that they do the typical mistakes, like even the little guy does? Like, I mean, you see a lot of people, they are too active, they have huge risks in their portfolio, they do things they don't know, they buy like penny stocks or a Chinese company they've never heard of.
Historically, the clients that we've gotten, we have full discretion. And we've discussed all that, and in many cases, some of them actually tried managing money on their own and weren't as successful for some of the reasons you raised. So in general, we haven't had that many issues with clients. We rarely get phone calls, but we try to really educate them first, try to get to really know them first. Then we try to work on educating them so they really understand what we do. And then third, we also send very long letters, as I've given you, 20, 30 page plus letters that really describe our philosophy, our approach, and what we're doing. So every year-end letter that I send out, I discuss all of our core holdings. So clients can see why we own it, etc., etc. Now, if we do get a phone call from a client, we're very, we love talking to our clients. We're very open to their thoughts, suggestions, and any changes in their life. For example, if something happens and their circumstances change, we will happily, very quickly, readjust their allocation. You know, if they sold a real estate property and they need more income, we'll increase the income portion of their portfolio as opposed to the equity portion. So we're very open to doing whatever is in the best interest of our clients. And that's another benefit, Tim, of our firm. We're employee owned, and we only have to answer to our clients. Sure. We don't have to answer to anyone else. And that's a big, big positive.
There's this study done by Dalba, and it says that people, every investor is really bad. The average, compared with the market. I think it's drastic.
It's drastic, and I've actually written about that, Tim, using some of the Dalbar information to some of our clients. You know, just off the top of my head, I remember they did a study. They do it quarterly, but they did a study that talked about the bull market from '82 to '99. And I'm making the numbers up, but let's say the market was up 18 or 20% a year during that 15, 17 years. The average investor got less than a third of that. Which the reason is, and that's actually an important component, the behavioral part of the business is actually in some ways more important than your analytical skills. You need to have nerves of steel. You need to have, you know, ice water running through your veins. And the reason the typical investor hasn't succeeded in general is, one, they don't have the emotional makeup that allows them to have done the research and have the confidence in their convictions. They don't have the time. They're doing it part-time. It's really tough when you see Mohawk go from 105 to 18 to hold on like we did. It's very, very difficult. The reason we held on, we knew Jeffrey Lorberbaum, the CEO. We knew Frank Boykin, the CFO. We knew the industry. We knew the business. They, along with Shaw, owned by Buffett, have 70% of the flooring in this country. We just felt housing's not going to go away. They had a great balance sheet. They had great products. We believed in them, and we held on. Most investors are simply not going to do that. They don't have the emotional makeup. They don't have the time to do the research. And as a result, they end up buying when they feel good, when the markets are up, and they end up selling when they get nervous when markets are heading down. So they do the exact opposite in most cases of what you really should be doing.
So humans are not built to invest, right? The brain is not good.
The brain is emotional. And what you have to do, and what Mr. Buffett is phenomenal at, and so are other great investors, but he's really great at it, is when turmoil hits, when challenges abound, that's when you really, really, really have to have the courage of your convictions and weather the storm. And most investors, and I would add even many professional investors, don't have the behavioral makeup to really be successful. It's really hard. It's really hard when you think to yourself, this is people's lifetime of savings, hard-earned money, and they've entrusted a large portion of that to us, and you're seeing things getting hit. It's very, very hard to maintain your equilibrium and maintain your discipline, your patience, and your focus. But the way we try to do it is through gaining insights and knowledge. And we always look out 5, 6, 7 years.
That's also a problem, the casino mentality. People look at stock prices like too much, and they think it's like Las Vegas a bit, right?
They do, and they don't view stocks. They view stocks as pieces of paper that can be bought or sold on a moment's notice. And, you know, 10, 20, I wrote about it in one of my letters, and I don't recall all the exact specifics, but 20, 30, 40 years ago, the average stock was held for, you know, 5, 10 years. Now the average stock's held for, you know, 5 months. People just don't hold things for long periods of time, and that's really impacted. It's become more of a casino out there. And then you have high frequency trading, you have short-termism, but I think long-term that really hurts investors. They spend money trading, they waste a lot of their emotions worrying about things. Our feeling is find really great companies that you understand, run by capable people, both in terms of their ability to run the business and to allocate the capital, and at a reasonable valuation. And then monitor it, keep your eye on it, study it, and then hold on. And that's really what you want to do. But fewer and fewer people, Tim, are doing that today. Fewer and fewer. It's hard.
My last question, volatility seems like very rough. Like Walmart went down 10% on one day, and Netflix went down 7%, and they're like, it's like a little shock that comes to some stocks, and it's brutal. Like, what is the reason for it? Like, so extreme, like.
Well, I think part of it is people are concerned, they're short-term oriented, but volatility is actually your friend if you're patient and have a long-term investment horizon like our firm, Lountzis Asset Management, does. We love volatility. Volatility creates opportunities. And frankly, when the Dow went from 18.3 to 15.3, we were starting to get really excited. But now it's back up to 17,000. So, valuations, while they're not crazy in most areas of the market, they're just not cheap. So it's very challenging to find compelling opportunities. We've been buying selectively over the last few years, but the last big push where we bought a lot of stocks was August of 11.
That was a drop.
That was when the market went from 16,000 down to 10.5. It was during the debt ceiling crisis in August, September, October of 11. The market really got hit during that time. 2000? It was down 19%, 2011.
Oh, okay.
Yeah.
And then we had now in August a week where the Dow Jones went down 1,000, and a few days later or next day again 1,000 points, right? It was
we went 4 years, almost 4 years without a 10% correction, and then we had one August 24th or so. So that's right. It's the market, and part of that, Tim, is even though there's a lot of money on the sidelines. Part of that is there's more people investing in some ways because there's nowhere else to put your money.
And how do you prepare your clients the 50% drop, the worst case thing that can happen? And it happens a few times in a century. I think Berkshire Hathaway dropped 3 times. 50%.
At least 50. It's at least 3 times 50% or more.
It's so difficult theoretically to explain it and stuff, but when it then happens, like
It's very, very hard and very, very painful. It's gut-wrenching. Your stomach's churning. But clients need to understand, as Mr. Buffett and Mr. Munger have said, you can get a steady 2-3% return, or you can get a more volatile 10 or 12% return. And the other thing that benefits us, Tim, is we're not all equity. So when people look at their accounts with us, we own a lot of fixed income. And so that also buffers. And I might also add, when you're managing money for high net worth individuals and families, capital preservation is preeminent. And it's a lot of work for us because we customize each portfolio. We don't have one hedge fund or one partnership. Every client is managed differently based on their needs. But it really helps to have that. And we have found over the years, if you do the math, many of these balanced accounts, now partly because bonds have done well for the last 30-some years, but balanced accounts aren't, if they're 60-40 or 70-30, the total return of that portfolio has not been significantly below 100% equity portfolio. However, in down periods, it has significantly outperformed. So that's another, focus that we have. We like the idea that we manage both equities and fixed income. And again, we've been very fortunate. It's probably half our assets now, these fixed adjustable preferreds. And they've been a wonderful buffer for our clients. And we found some shorter duration ones. So we've now laddered portfolios with these fixed adjustable preferreds from 17, 18, 19, 20, 22, 23, and 24. So we have clients that have all this income coming in, which is really a great, great thing for them.
Okay, great. Thank you very much.
Thank you for having me.